Picture this: November 15th, 1923, Berlin, Germany. A factory worker named Heinrich clutches his weekly wages, 4.2 trillion paper marks, and sprints through the streets toward the nearest bakery. His heart pounds because he knows the truth. By tomorrow morning, that money will buy half as much. By next week, it might not buy a cup of coffee. He arrives to find the price of bread has tripled since yesterday. It now costs 200 billion marks for a single loaf. The baker's wife stands behind a cash register overflowing with worthless paper. The currency has become so worthless that children use stacks of banknotes as building blocks. Families wallpaper their homes with 1,000-mark bills because it's cheaper than buying actual wallpaper. But across town, Heinrich's neighbor Wilhelm walks calmly into a shop and purchases a month's worth of groceries with a single gold coin. Same day, same city, same economic apocalypse. Two completely different realities. This isn't fiction. This was Weimar Germany. Fast forward to September 15th, 2008. Lehman Brothers files the largest bankruptcy in American history. $639 billion in assets gone. Within days, the stock market erases $10 trillion in wealth. Retirement accounts vaporize. Yet some people walked through that crisis barely scratched. Fast forward again to March 2023. Silicon Valley Bank experiences the fastest bank run in history. $42 billion withdrawn in a single day. A bank worth $8 billion at market open becomes worthless by Friday afternoon. 48 hours from thriving to seized. Here's what keeps me up at night. When you study every major banking crisis of the past century, from Weimar Germany to Argentina's Corralito to 2008 to last year's failures, you find the exact same pattern. The same assets survive. The same assets go to zero every single time. Not theory, historical fact. The math is terrifying. In Weimar Germany, the exchange rate went from 4 marks per dollar to 4. 2 trillion marks per dollar. Trillion. In Argentina, 2001, 57. 5% of the population fell into poverty within months. In Venezuela, the currency lost 99% of its value, and 8 million people fled. Yet, in each disaster, certain assets didn't just survive, they thrived. Gold increased purchasing power during Weimar. Farmland generated positive returns during 2008, while residential real estate collapsed. Swiss francs appreciated while local currencies burned. Today, I'm showing you the 5 specific assets that protected wealth through every banking crisis in modern history. More importantly, I'm showing you exactly why they work. And I'm revealing which assets went to zero so you know what to avoid when the next crisis hits. Because the question isn't if, it's when. And the difference between survival and ruin comes down to one thing: whether you own the right assets. Every banking crisis follows the same pattern. Stage 1, excessive debt accumulates during good times. Stage 2, a trigger event causes confidence to crack. Stage 3, bank runs begin as depositors rush for exits. Stage 4, asset prices collapse from forced selling. Stage 5, currency devaluation as governments paper over damage. We saw this in the Great Depression when 9,000 banks failed between 1930 and 1933, wiping out $3 billion in deposits. We saw it in Argentina in 2001 when the government froze all accounts, limiting withdrawals to $250 per week, trapping $70 billion. We saw it in 2008 when Washington Mutual collapsed after depositors withdrew $7 billion in 10 days. The timeline accelerates. In 1930, bank runs took weeks. In 2023, Silicon Valley Bank went from announcing a capital raise to complete collapse in 36 hours. Modern panics move at digital speed. But the pattern remains identical, and so do the assets that survive. Number 1, gold. And I don't mean gold as some abstract hedge. I mean gold as the single most reliable crisis survivor in recorded financial history. Let me show you the brutal math. In January 1919, 1 ounce of gold cost 170 German marks. By November 1923, that same ounce cost 87 trillion marks. Gold didn't just maintain purchasing power during Weimar hyperinflation. It doubled its real value while everything else burned. Those who converted paper marks to gold could still buy property and food when neighbors used wheelbarrows of cash to buy bread. During the Great Depression, gold stocks became the only equity investment that prospered. Homestake mining rose 474% from 1929 to 1933, while the broader market fell 89%. Dome mines rose 558%. The stock market took 25 years to recover. Gold holders had already rebuilt their wealth. During 2008, gold initially dropped 28% from March to October as panicked investors sold everything for cash. This is critical. During acute liquidity crises, even gold gets sold temporarily. But by year-end, gold posted positive 6% returns, while stocks lost 38%. By 2011, gold reached $1,919 per ounce, more than doubling from pre-crisis levels. Here's what most people miss. Gold has zero counterparty risk. A bank can fail, a government can default. A corporation can go bankrupt, but gold cannot go to zero because it doesn't depend on anyone else's promise. It exists. It has value. It has for 5,000 years. Right now, as of late 2025, gold has reached all-time highs above $4,500 per ounce, a 65% gain this year. Central banks accumulated 980 tons in the first 3 quarters of 2025. They're not buying because everything is fine. They're buying because they see what's coming. Pattern recognition, verified, undeniable. Number 2, agricultural land and farmland. This surprises people because they remember 2008 and think real estate collapsed. Residential real estate collapsed. Speculative housing collapsed. But farmland did the opposite. Here's the brutal math. During 2008, the S&P 500 lost 46%. Conventional real estate posted double-digit losses. Farmland, according to the NCR index, gained 17%. Positive 17% during the worst financial crisis since the Great Depression. During the dot-com crash from 2000 to 2003, the S&P lost 42%. Farmland gained 14%. During COVID, when markets crashed 37% in weeks, farmland rose 7% in 2021. Since 2000, the S&P 500 has posted negative returns in 28 quarters. In 26 of those 28 quarters, farmland posted positive returns. That's a 93% hit rate during market downturns. The mechanism is brutally simple. People always need food. Demand for agricultural products is inelastic. It doesn't disappear during recessions. Only 7% of Earth's surface is suitable for farming, creating permanent scarcity. And farmland produces cash flow through crop yields, regardless of what financial markets do. During the Great Depression, farmers who owned their land outright actually prospered. They sold goods at rising prices while urban goods deflated, paid off debts with devalued currency, and maintained self-sufficiency while urban populations starved. There's a reason billionaires like Bill Gates have accumulated over 270,000 acres of farmland. There's a reason aristocratic families preserved wealth for generations through agricultural estates. Land produces, land persists, land survives. The caveat: the 1980s farm crisis saw farmland values drop 40%. But look at why. Farmers had borrowed at 95% loan-to-value ratios. When rates spiked, they couldn't service the debt. The lesson isn't that farmland fails, it's that leverage destroys everything, even the best assets. Number 3, hard currencies from stable countries. And here's what blows people's minds. During local currency crises, holding physical cash in a strong foreign currency can be the difference between survival and ruin. Let me tell you the Argentina story. In December 2001, the Argentine government implemented the corralito. They froze all bank accounts and limited withdrawals to 250 pesos per week. But here's the devastating detail. Dollar deposits in Argentine banks were forcibly converted to pesos at 4 pesos per dollar. Then the peso collapsed to 4 pesos per dollar. Do the math. If you had $100,000 in an Argentine bank, it got converted to 140,000 pesos, worth just $35,000. You lost 65% overnight by government decree. But Argentines who kept physical dollars outside the banking system preserved their wealth entirely. One citizen testified about losing $40,000 of his $77,000 in the corralito. His neighbor who kept dollars in cash at home lost nothing. Same city, same crisis. One trusted the bank, one didn't. The Swiss franc has been the most consistent safe haven currency for decades. Since 1974, the US dollar has devalued approximately 75% against the Swiss franc. During every major conflict, the Swiss franc strengthens, averaging 85% gains per month during geopolitical stress. During 2008, the Swiss franc appreciated so significantly that the Swiss National Bank had to intervene to stop it because it was hurting Swiss exporters. That's how powerful the safe haven effect becomes. The mechanism is straightforward. Switzerland is politically neutral, has strict banking regulations, low inflation, diversified economy, and holds the 8th largest gold reserves in the world. When the world panics, money flows to stability. Pattern recognition, verified, undeniable. Quick pause. If you're realizing that everything you thought you knew about protecting your wealth might be wrong, hit that subscribe button. This channel is Financial Forensics. We show you patterns that could save your financial life. Now back to the assets that survive. Number 4, U.S. Treasury bonds from stable governments. This is the traditional safe haven, and the data largely supports it, with important caveats. During 2008, long-term U.S. Treasury bonds gained 17%, while stocks fell 49%. During the LTCM collapse in 1998, Treasuries gained 7%. During the dot-com crash, Treasuries gained 13%. In November 2008, Treasury yields briefly went negative. Investors were literally paying the government to hold their money because they trusted nothing else. This is the flight to quality phenomenon. The mechanism: The U.S. Treasury market is the largest and most liquid in the world, 28. $5 trillion with daily trading volume of $910 billion. During crises, liquidity is survival. Treasuries provide that when everything else freezes. But here's what critics miss. In 2022, Treasuries posted negative 13% returns. In March 2020, even Treasuries were sold as institutions desperately raised cash. And in April 2025, Treasury yields rose while the dollar fell simultaneously, a breakdown suggesting investors may be questioning U.S. fiscal stability. The lesson: short-term Treasury bills remain the most reliable safe haven. Long-term Treasuries carry interest rate risk. Diversification matters even within safe havens. Number 5, and this is the most important, dividend-paying stocks from essential businesses, not growth stocks, not speculative tech. Companies that produce things people need regardless of economic conditions and pay you while you wait. Here's the brutal math. During 2008, S&P 500 stock prices fell 55%, but S&P 500 dividends fell only 6%, earnings per share collapsed 92%, dividends barely budged. Across all recessions since 1946, the average dividend cut is just 5%, while stock prices fall an average of 32%. Dividends are 10 to 15 times more stable than stock prices during downturns. The companies that matter provide essential services. Utilities keep lights on regardless of recession. Healthcare companies treat the sick regardless of unemployment. Consumer staples sell food and household goods regardless of GDP. Telecommunications provide services people won't cancel. Verizon's sales fell only 1% during 2008, and its stock outperformed by 20%. Realty income maintained occupancy above 96% through both 2008 and COVID. These businesses generate cash regardless of conditions. The mechanism is simple. Essential demand creates essential cash flow, creates essential dividends. When you own these businesses, you don't need to sell at the bottom. You collect income, reinvest during panic, and emerge stronger. The warning: avoid financial sector dividends during banking crises. Bank of America yielded over 5% in 2007. By 2009, it yielded 23% after forced cuts. Citigroup's dividend was essentially eliminated. During banking crises, bank dividends fall first. Now let's talk about what goes to zero, because understanding what survives is only half the equation. Bank stocks during banking crises are lottery tickets with negative expected value. Lehman Brothers stock traded at $65 per share in 2007. After September 2008 bankruptcy, it traded at 21 cents, a 7% loss. Washington Mutual traded at $46 in 2006. When trading was halted during seizure, it was at 16 cents. Silicon Valley Bank fell 60% on March 9, 2023, then another 62% before being halted. The pattern is consistent. Bank stocks can and do go to zero, because banks operate with 90% or more debt. When confidence cracks, equity holders are wiped out first. Subordinated bank debt, particularly AT1 bonds, can be wiped out by regulatory decree. Credit Suisse. AT1 and bondholders lost $17 billion overnight when Swiss regulators wrote their bonds to zero during the UBS merger. These instruments are designed to absorb losses during crises. Uninsured bank deposits above FDIC limits are exposed to bail-ins. In Cyprus, 2013, depositors at Bank of Cyprus with more than 100,000 euros saw 47. 5% of their excess deposits forcibly converted to bank shares, trading at 20 cents on the euro, an 80% loss. Depositors at Laiki Bank lost everything above insurance limits, and local currency during hyperinflation goes to zero in the most devastating way. Venezuela's Bolivar lost 99% of its value. The currency required 14 zeros removed through 3 redenominations. 8 million people fled. Zimbabwe printed $100 trillion bills before abandoning the currency entirely. Prices doubled every 24, 7 hours at peak inflation. So where are we seeing these warning signs right now? Because the same patterns that preceded every previous crisis in history are flashing amber, and in some cases red, across multiple indicators simultaneously. Ignore them at your own peril. And let's start with U.S. banks, because the stress is building beneath the surface. According to Q4 2024 FDIC data, American banks are sitting on $482 billion in unrealized losses on their securities portfolios, a 5% increase from the previous quarter. This is the exact same vulnerability that destroyed Silicon Valley Bank in March 2023. Here's how this works. Banks bought long-term bonds when interest rates were near zero. Then the Fed hiked rates to 5%. Those old bonds paying 2% are now worth far less than face value. The losses are unrealized, only because banks haven't sold them yet. But the moment depositors get scared and start withdrawing money, banks have to sell those bonds to meet redemptions. Unrealized becomes realized. Paper loss becomes actual loss. The doom loop begins. $482 billion. That's larger than the entire GDP of Austria. It's sitting there on bank balance sheets like a ticking time bomb. Commercial real estate is the slow-motion crisis unfolding in plain sight, and somehow most people are still not paying attention. U.S. banks hold over $3 trillion in commercial real estate loans. Of that, $2 trillion is now classified by analysts as potentially troubled. Office delinquencies have reached nearly 12%, higher than the peak during the 2008 financial crisis. And here's what should terrify you. $936 billion in commercial real estate mortgages mature in 2026 and 18. 6% increase from 2025 maturity levels. These buildings are worth 30 to 50% less than they were when the loans were originated. Office buildings are half empty thanks to remote work that's permanent, not temporary. When these loans mature, borrowers can't refinance. Banks face massive losses. Banks with high concentrations in commercial real estate will face a refinancing wall with no exits. Regional banks are particularly exposed. Some smaller banks have 30 to 40% of their loan books in commercial real estate. When those loans default, it wipes out capital rapidly. Same pattern, different trigger. Consumer stress is accelerating across multiple metrics. Auto loan delinquency rates have hit 88%, a 15-year high. Subprime auto delinquencies have reached 78%, the highest since tracking began in 2000. These are Great Recession levels. Over 7 million vehicles were repossessed in 2024, the most since 2009. When people can't make their car payments, recession is already here for them. Credit card balances have hit $2 trillion, an all-time record. Credit card delinquencies are rising, now above 3%. Student loan delinquencies would be even worse if not for the various forbearance programs. The consumer is stretched thin. Savings rates have collapsed. Excess pandemic savings are gone. The buffer is exhausted. And then there's the elephant in the room that nobody wants to discuss: global sovereign debt. The numbers are so large they become meaningless to most people, but they shouldn't be. U.S. public debt now exceeds $38 trillion. Annual interest payments have surpassed $1 trillion for the first time in history, more than the entire defense budget. The debt-to-GDP ratio has surpassed 120% and climbing. The deficit hit $19 trillion in fiscal 2024. We're adding $1 trillion to the national debt every 100 days now. Ray Dalio, founder of Bridgewater Associates, the world's largest hedge fund with $125 billion under management, has warned repeatedly throughout 2025 that we're in the late stages of a major debt cycle. He forecasts a potential U.S. debt crisis emerging somewhere between 2027 and 2029. He compared current conditions to 1929 and 1937, noting that the parallels are striking. When one of the most successful investors in history, with access to better data than anyone, starts making 1929 comparisons, you should probably pay attention. China's property sector continues its fourth consecutive year of decline. Property investment fell 2% in 2025. China's total debt-to-GDP ratio has reached approximately 300%, one of the highest in the world. The property sector represents 30% of Chinese GDP. Evergrande defaulted. Country Garden defaulted. The contagion is spreading. Fitch downgraded China's sovereign credit rating in April 2025. Japan's government debt sits at 230% of GDP, the highest among all industrial nations. The yen has fallen over 30% against the dollar over 5 years. The Bank of Japan is trapped. They can't raise rates meaningfully without causing a debt crisis. But keeping rates at zero means the currency keeps falling. There's no good exit. The IMF's Global Financial Stability Report from October 2025 states it directly, and I quote, "Financial stability risks remain elevated. Markets appear complacent to this shifting ground. Valuations have returned to stretched levels." And translation, things are dangerous and nobody seems to care. The Bank of England's December 2025 Financial Stability Report warns that U.S. equity valuations are close to the most stretched they have been since the dot-com bubble. The bubble analogy comes from the Bank of England, not from doom and gloom bloggers. Same pattern, same stages, same outcome. The question isn't if it will happen, it's when, and whether you'll be positioned correctly when it does. So here's the question that actually matters. What do you do with all this information? Because knowledge without action is worthless. First, evaluate your exposure to assets that go to zero during banking crises. This isn't optional. Do this today. Check your bank balances against FDIC insurance limits. $250,000 per depositor, per bank, per ownership category. If you're above that limit, you're taking unnecessary risk for zero additional return. Spread deposits across multiple FDIC-insured institutions. Yes, it's inconvenient to have multiple accounts. Know what's more inconvenient? losing 50% of your money in a bail-in like Cyprus depositors did. Examine any subordinated bank debt or AT1 bonds in your portfolio and understand they're specifically designed to absorb losses during crises. Credit Suisse AT1 holders thought they were holding safe bonds. They lost everything. If you own these instruments, understand you're making a bet that no banking crisis occurs. That bet has lost repeatedly throughout history. If you own bank stocks, understand you're making a leveraged bet on the banking system. During normal times, fine. During banking crises, catastrophic. Position size accordingly. Second, build positions in crisis-surviving assets before you need them. This is critical. You can't buy gold or Swiss francs or farmland during the crisis when premiums spike and liquidity dries up. You buy them now, during calm periods, at reasonable prices. For gold, allocate 5 to 15% of your portfolio depending on your risk tolerance. Physical gold in your possession or in allocated storage. Not paper gold, that's a claim on someone else's gold. The whole point is no counterparty risk. GLD ETF is fine for trading. Physical gold is for crisis protection. For agricultural exposure, consider farmland REITs like Farmland Partners or Gladstone Land if you can't buy actual farmland. These provide exposure to farmland appreciation and crop revenue without the operational complexity of running a farm. Or if you have significant capital, buy actual farmland through specialized dealers. It's real, it's tangible, it survives. For Swiss franc exposure, currency ETFs like FXF provide easy access without needing a Swiss bank account. Or open an account with a Swiss bank if you have significant assets and want the full protection of Swiss banking law and insurance schemes. Third, focus on quality dividend payers in essential sectors and build positions over time. Utilities, healthcare, consumer staples, telecommunications, companies with histories of maintaining and growing dividends through multiple recessions. Screen for companies with dividend payout ratios below 60%, meaning they're paying out less than 60% of earnings as dividends. This provides a cushion. If earnings fall, they can maintain the dividend. Avoid companies paying out more than 100% of earnings as dividends. That's unsustainable. Look for companies with 20 plus years of consecutive dividend increases. This shows management commitment to the dividend through multiple economic cycles. Dividend aristocrats and dividend kings lists provide good starting points. Fourth, maintain liquidity in short-term treasury instruments. Keep at least 10 to 20% of your portfolio in cash or cash equivalents, treasury bills maturing in 3 to 6 months. This serves two purposes. One, it's safe and liquid if you need it. Two, it gives you dry powder to buy assets when they're on sale during crisis pricing. The investors who made fortunes buying stocks at 2009 lows or 2020 lows had one thing in common. They had cash available when others were forced sellers. Cash is optionality. Cash is patience. Cash lets you be greedy when others are fearful. The wealthy don't panic during crises because they own assets that survive crises. They've studied history. They've looked at every major banking crisis of the past century. They understand the pattern, and they position accordingly before the panic begins. Not during, before. This isn't about timing the market perfectly. It's about positioning yourself so that whether the crisis happens next month or next year or 3 years from now, you're protected. And more importantly, you're positioned to profit when others panic. Here's the brutal truth that nobody wants to hear, but everyone needs to understand. Banking crises are not random events. They're not acts of God. They're not unpredictable black swans. They're the inevitable, predictable result of excess debt, overvalued assets, and misplaced confidence reaching their mathematical limits. The math doesn't care about your feelings. The math doesn't care about central bank promises. The math doesn't care about government interventions. Eventually, the math wins. It always wins. Every generation experiences at least one major banking crisis. Your grandparents had the Great Depression. Your parents had the 2008 financial crisis. You will have yours. The only question is whether you'll be prepared for it or devastated by it. Most people are unprepared because they make a fatal assumption. They believe what worked yesterday will work tomorrow. They believe the banking system is safe because it's been safe their entire adult life. They believe their currency will hold value because it's held value so far. They believe housing always goes up because it's gone up their whole life. These beliefs feel reasonable until the day they're proven catastrophically wrong. And by then, it's too late. The difference between those who emerge from crises stronger and those who emerge devastated comes down to one thing: what they owned when the music stopped. Not what they owned when times were good. What they owned when confidence cracked and the system froze. Remember Heinrich and Wilhelm from November 15th, 1923, Berlin? Same city, same economic apocalypse, same day. Heinrich sprinted through the streets, clutching 2 trillion marks that would buy half as much by tomorrow. Wilhelm walked calmly with a single gold coin that bought a month of groceries. The hyperinflation didn't discriminate between them. The banking crisis didn't choose victims randomly. The currency collapse didn't pick winners and losers based on luck. Their preparation did. Their asset allocation did. Their understanding of history did. Heinrich trusted paper promises backed by a bankrupt government printing money. Wilhelm owned real assets with intrinsic value. Heinrich's entire life savings evaporated. Wilhelm preserved his wealth and bought property from desperate sellers at depression prices. That choice, that single difference in what they owned, determined their family's financial futures for generations. Wilhelm's grandchildren inherited wealth. Heinrich's grandchildren inherited poverty. So let me summarize what history has taught us through 100 years of banking crises across dozens of countries. Gold survives. It maintained purchasing power through Weimar, prospered during the Depression, doubled during the 2008-2011 aftermath. No counterparty risk, no government promises required, just 5,000 years of monetary history. Farmland survives. It gained 17% during 2008, while the market fell 46%. It produces food, regardless of what financial markets do. It can't be printed. It can't default. It just produces. Hard currencies from stable countries survive. Swiss francs appreciated while local currencies burned in Argentina, Venezuela, Zimbabwe. Political neutrality and fiscal discipline create lasting value. Treasury bonds from stable governments survive. Flight to quality is real. Liquidity matters. Short-term treasuries provide safety when everything else freezes. Dividend-paying stocks from essential businesses survive. Dividends fell only 6% in 2008, while stock prices fell 55%. Essential demand creates essential cash flow, creates essential dividends. Companies that provide electricity, healthcare, food, and communications generate cash through any crisis. And on the other side, bank stocks go to zero. Lehman, Washington Mutual, Silicon Valley Bank, the pattern repeats. Leverage kills equity holders first. Subordinated debt gets wiped out. Credit Suisse AT1 holders lost $17 billion overnight by government decree. No bankruptcy required. Uninsured deposits get frozen or confiscated. Argentina's Corralito, Cyprus bail-ins, your money trapped behind government fences. Local currencies get printed into worthlessness. Venezuela, Zimbabwe, Weimar Germany. The outcome is always the same when governments try to print their way out of debt. Leveraged positions get margin called into oblivion. Leverage amplifies everything, including destruction. The pattern is clear. The history is documented. The warning signs are flashing right now across multiple indicators: bank unrealized losses, commercial real estate stress, consumer delinquencies, sovereign debt explosions, central bank warnings. The only question remaining is this: which category do your assets fall into? Are you holding what survives or what goes to zero? If you found this valuable, if you're realizing that everything you thought you knew about asset protection needs to be reconsidered, hit that subscribe button right now. This channel is Financial Forensics. We don't repeat conventional wisdom that fails during crises. We study the autopsies of past failures to show you patterns before they repeat. Drop a comment telling me which asset class you're most focused on building. Are you accumulating gold, researching farmland, building dividend portfolios? I read every comment. The community here is learning together. And here's what you should do right now, today, before you move on to the next video. Open a spreadsheet. List every asset you own. Put each one in a category. Survives or fails during banking crises. Be honest. If you're not sure, assume it fails. Then calculate what percentage of your wealth is in the fails category. If it's more than 50%, you have work to do. If it's more than 75%, you're dangerously exposed. Start repositioning. Not all at once, but start. Because when the next crisis hits, and it will hit, it will be too late to prepare. The time to buy gold is before the currency crisis. The time to buy farmland is before the food crisis. The time to buy Swiss francs is before the dollar crisis. The time to build your dividend portfolio is before the stock market crash. The time to position is now, while it's still calm. While prices are reasonable, while everyone else thinks you're crazy for preparing. Because one day, maybe next year, maybe in 5 years, you'll wake up to news of a bank failure, then another, then bank runs, then frozen accounts, then currency interventions. The pattern will play out exactly as it always has. And on that day, you'll either be Heinrich sprinting through the streets with worthless paper, or Wilhelm walking calmly with real assets that hold value. The crisis won't discriminate, but your preparation will determine everything.